Hello, Dr. Kohli. Thank you for coming on the show. We were just discussing the new instrument launched by the RBI governor. The standing deposit facility, unlike the reverse repo rate, lets RBI absorb liquidity from the market without keeping G6 as collateral. How will this alter the landscape and why introduce it now, 8 years after it was recommended?
I think the timing is important. For one thing, it's 8 years ago it was recommended, and the RBI had been wanting it for very long. But it came from a standpoint more of external capital account management and managing excess inflows. Currently, however, that is not the main issue. If at all, actually, global financial conditions are tightening, and the capital flow cycle, as we have seen already in the last several months, is reversing. My sense is that the situation is more domestic in the context of large government borrowing and unprecedented liquidity that the Reserve Bank has injected into the economy in the wake of COVID, and even before that, into long-term repo operations and etc. So now that the time is for reversal. So for the RBI to introduce it now, I think it is probably that it provides it greater flexibility. It probably wants more GSECs with it at its disposal to give it more flexibility for monetary policy operations ahead, because the times are very uncertain. It has to scale back liquidity.
Now, coming back to the monetary policy decisions that we discussed right now, India has maintained its monetary policy stance while the developed world is raising its rates. How do you see the risks coming to the economy from this interest rate differential? And do you think RBI should be more hawkish about its stance?
About the interest rate differential, I think we have seen actually the developments in the last several months, and particularly at the end of the year, that directionally the risks are very clear, which is exit of capital, drawdown of reserves. The RBI, as far as if I've got the numbers correct, it is already, the reserves are down by some $30 billion already has been sold. And not just that, it's also the external position it is reflected in that import cover is down to 12 months, and so on. So what we have not seen so far is actually the pressure upon the exchange rate. So, and if that comes about because of the current account deficit widening or sudden unexpected slowdown in exports, then things could aggravate. So, these are the usual problems that we see of a widening interest rate differential between the domestic and the foreign interest rates. And the situation is quite apparent. As far as hawkishness is concerned, whether it should be more hawkish, I think it is operating in an inflation targeting regime, and it has very little choice, or rather, it has no choice except to adapt or move in consonance with its forecast. And the price shocks, particularly from oil and energy and food prices, have compounded. Plus, the uncertainty about the evolution of prices is very high. So it has no choice except to be hawkish. Uh, how hawkish should it be? It has indicated, the governor has indicated very clearly that the interest rates have to turn real. We have to move towards that. Now, within that movement, I think that I would say that it has all the tools, as it said. It is in a position, it has already communicated that we will act as and when it's required, and whatever needs to be done, we will do it. So let me put the question this way: can it be blindly hawkish? I think not, because unlike the advanced countries, the demand conditions in India are extremely weak.
Now, we have mentioned inflation targeting at least thrice now. Now, has the inflation targeting failed, or is there a problem with that approach? And you've written about it a lot. This is something that you've rallied about a lot.
I have written a lot about it, and I'm one of those who actually argued against its introduction way back in 2013 and 14. In fact, from 12 onwards, there was this talk about shifting to CPI as an anchor. And I had my reasons, and they are there in the public domain. But coming back to your question about success or failure, see, it was introduced formally in 16 and informally in 14. I think it's too short a period to declare the success or failure of any particular new monetary policy regime. And we haven't gone through, it has not been exposed to different kinds of business cycles. and more than that, different kinds of shocks, because it's a forward-looking regime and it affects the inflation with a lag. And it's essentially a targeting of an inflation forecast. We have already seen how the US Fed has got it wrong from its readings of inflation about transitory, etc., from last year. Expectations have begun to rise in the West also, although in the long term, expectations still remain somewhat lower. But we need to, I think it's a test because it's a reversal after 30 years. The inflation expectations do not get de-anchored and they continue, or in fact, if they are re-anchored, because the US central bank has to make a very steep adjustment. It has to bring down inflation by as much as 4 percentage points. And if it can do that without driving the economy into a recession and re-anchor expectation remains, if that happens, then I would say it is a great success. And I think the same applies to India. One more point is that we haven't seen, it was argued, one of the strongest arguments for introduction of IT was that low stable inflation will yield long high growth rates, sustainable growth rates for long years, many years to come in the future. We haven't seen that. Macroeconomic stability and price stability hasn't brought growth in India.
Now, coming back to the RBI forecast, the last financial stability report had said that the capital to risk weighted asset ratio of SCBs had improved. The provisioning coverage ratio was also high, but it had also pointed out that the NPAs would rise next year. And also there's stress in MSMEs. Are we looking at a balance sheet crisis because of the aggressive monetary tightening and the low growth?
Things. One is, I think the balance sheet crisis would be a little far off to speculate upon. I think the chances of that are lesser because we have seen that the corporates have deleveraged, for number one. And number two, there hasn't been much lending in the last 2 years. So, past debts. Past debts, most of the corporates actually took the benefit of equity and corporate bond market because the market rates were so much lower than bank lending rates. So they actually exchanged their loans. So those are fine. Now we come back to the MSMEs. Frankly, no one knows what's the situation of MSMEs because even before the pandemic, the MSME debt and loans have been under regulatory reprieve for a very long time. I think from 2019 onwards. So that's what we are now 4 years. And even now, the high lending that we are seeing in the monthly data, in bank credit data, includes that the emergency credit lines which have been given out, extended by the government in the wake of the pandemic. So inclusive of these restructuring and the guarantees that the government has held out, we do not know. And we also do not know what is the NBFC lending position. Bank credit, we know, but we don't know. And we also know that the banks have extended a lot of lines to the NBFCs. Overall, I would say that the balance sheet crisis feedback, there is one source of pressure upon the banks. Let me just conclude that by adding that the holdings of government debt are very high, unprecedented, because government debt has increased. Borrowings are very hugely elevated. So the reversal in the interest rate cycle will, of course, impact the bank's feedback upon the bank's balance sheet. But definitely a rise in interest rates affects the bank's balance sheets and their, their earnings and the interest margins.
Thank you, Dr. Kohli. We hope to soon have you back again. Thank you for coming on the show.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.